Hello, everyone. My name is Adeo Resi. I'm here to discuss with you today navigating the LP mindset in a time of a crazy market. And right now, the markets are down. The volatility index is up. Yesterday, the market was up. The volatility index is down. There's a lot of crazy things happening in the world, trade wars and the like. And at the end of the day, if you're a venture capitalist and you're raising money for a fund, you just got to triumph through adversity. And we're going to be talking about what the LP mindset is right now and some tactics for you to navigate it. I'm joined here by our compatriot from Dessal Capital, Marco Hara. He's in Finland. Marco, do you want to do a quick introduction of yourself?
Yes, my name is Marco. As Adele mentioned, this is not my first rodeo, so to speak. I think the first one was Black Monday, 1987. So I've been around for a while and seen things like this happening. After that, it was happy 90s for venture capital, and then we saw the dot-com bubble coming in, a couple of calm years, and GFC. After that, Euro crisis, COVID, and now this. And I've been doing this for quite some time. Also on the public markets, listed markets, credits, everything, and most of the time, private equity and venture capital.
So, yeah, Marco, so you've been through this before. Maybe I'll start with just quoting some stats that we've seen. So we run at Dessel Group, we run a lot of different things. So we run an accelerator where we create new venture capital firms and we help venture capital firms on Fund 2 and Fund 3 get started. We also work with limited partners to invest in venture capital firms and funds. We have a technology stack that runs many of these funds, so we see the actual numbers. And then last but not least, we have a capital stack where we match limited partners with general partners, and we have a fund of funds that Marco helps run. So let me just give you a sense of what we're seeing. So cohort 18, which we're recruiting for right now, had the second largest number of applicants in the history of any program on the deadline on Monday. So there's a lot of humans that still want to enter venture capital regardless of the volatility. Cohort 17, which is operating right now, has the largest number of commitments from limited partners into venture capital firms in history, and this is happening in the midst of this volatility. So while there's a lot of volatility in the market, managers are raising money right now. In addition to that, this we train limited partners, and the LP Institute, which it's called, is starting today, later today. So Marco and I are on another webinar together, and that has the largest number of limited partners coming in to learn how to better invest into emerging managers. And that cohort's pushed the total amount of money that of limited partners that we're working with to over $1 billion that they're going to deploy in the next 12 to 18 months. So there's a lot of uncertainty in the market. There's a lot of negativity happening in the world today. There's war, political uncertainty. Yet we're seeing a lot of positive signs. And I want to just talk a little bit about war, uncertainty, et cetera. So we did ask managers a few weeks ago, including limited partners, hey, what are the big trends that you foresee in Q2? Of 2025, and political uncertainty was number one, and we've never even seen anything like that in the past. AI has been number one forever, and just continues to be number one. But actually, political uncertainty for Q2 was number one. Interestingly enough, deep tech and robotics was number two, and AI slipped to number three. Now, once we opened up that survey to hundreds of people in the internet, AI shot back up to number one, but when we were just serving limited partners and general partners, political uncertainty was number one. So there's cause for concern. And I'll tell you one other thing, and I'm going to dive, that will be the first area that you, Marco, and I will dive into conversation, that we're seeing a lot of money essentially on the sidelines. I heard a stat from the former Treasury Secretary that he's estimating 6 trillion. I did some math a week and a half ago. It was 4 trillion, but it's actually increased. So there are trillions of dollars of money that have been removed from equity markets, removed from debt markets, removed from various asset classes, and are essentially sitting on the sidelines in one form or another, looking to be reallocated at the moment. But Marco, you and I were talking this morning, and you had mentioned that a lot of the big LPs that you know are just stopping everything. And maybe you could tell us a little bit about that.
Yes, that is typical. It always happens when the times are like this, and uh, it's about uncertainty. It means that it's not only venture capital, which is a small asset class in a way. It's not only about private equity. It's also about debt markets, listed markets. Basically, when you don't know what you do, you don't do anything.
So you were saying that a lot of these big managers, you know, are literally, they've completely stopped everything.
That's normally what happens. Sometimes, people think that when markets go down or when they go up a lot in a short period of time, that there would be a huge amount of institutional selling. That's normally not the case. There are a lot of traders. The daily volumes could be like trading volumes and stuff like that. There could be some hedge fund players, but the big institutional investors, they know that they just can't start unloading. They just can't do it. There is no real liquidity for that. So basically, it means that they get to that kind of stealth mode and try to do as little as possible. That's what I've seen in the past. And I spoke with five um, people that I know pretty well from the institutional side. They manage about 400 billion or so, and I spoke with these guys, and you know that's the case how it is right now. They are not in any panic. They're not in any panic at all, but they're not buying, they're not selling. They're just on the sidelines.
So you also brought something else up that I want to dive into a little bit here, which was like, given this scenario with the dollar and the fact that a lot of people have concentrations in US equities, US venture, US dollars,
Yeah.
uh, that's also been kind of a forcing function for them to stop. And maybe you could unpack that a
Yeah,
little bit.
yeah, that is true because these guys I spoke with are from Europe, obviously, in this case. And what happened was that everything they had in dollars, currency, listed, T-bills came down simultaneously. And
Right,
and
because the
in that,
dollar went down,
yeah,
right?
everything. And that is very unusual to see that because in most cases, like the safe haven or the flight to quality in these kind of cases would have been the United States. And in this case, that was not the case. And obviously, we know what the Chinese guys are doing with the T-bills right now, maybe even some Japanese. So it's highly complicated situation. Uh, and I would say that what they told me is that they are not unloading, but they are not definitely buying anything.
Yeah, and so just to explain, if your stock prices go down, and let's say you're in a foreign country outside of America, but also the dollar goes down, right? You get hit from both sides because the currency is devaluating, right? So then it's like, oh, all of a sudden, if you have a currency decline, your relative position in any, even if it stayed the same, would go down. And then, of course, the assets themselves went down. So you'd have essentially a double down, if you
Yeah.
will, and not
And
a good
by
way. It's not like I'm
yeah,
doubling down on my
yeah,
on
and by the way, if you start to unloading your position and buying euros,
that would be
$7,
yeah, exactly.
I mean, it's like a never-ending story there.
So that's just causing more and so we're definitely so here's the good news. We're seeing bright spots in that in a lot of the first quarter, I would say most LPs were frozen, like Marco said. However, just recently, at the end of the first quarter, going into the beginning of second quarter, we've seen a dramatic uptick in the number of LPAs being signed in the network. So there is movement, and I'd like to sort of switch the attention. So most LPs are frozen. The markets are extremely volatile. As you said, especially LPs with big money, they can't really do anything anyway because there's not enough liquidity in the market for them to dump positions. So what are some of your thoughts on what managers can do to get limited partners excited in this market environment?
It very much depends on what you do and where are you doing it.
Right.
I mean, these markets are not created equal, nor are the LPs or GPs. It's very much about that. Uh, Obviously, we are going to talk very much about venture capital here, emerging managers, but I would say that the impact of these tariffs is going to be much worse for private equity than venture capital. There are very many reasons for it. So I would say that in relative terms, venture capital investments, and in particular in the United States, are in a better spot already because they are not affected the same way as private equity is for the tariffs because they are in total different businesses. Most of the venture capital companies that the venture capitalists are funding, they are not in the industries. They could be like services or digital kind of stuff, and the effect of on tariffs on those businesses is going to be different, much less than it would be on traditional private equity. So I would say that European countries could be affected severely, like Switzerland, maybe Ireland and Germany, which are US export dependencies. And the most vulnerable sectors could be like automobiles, machinery, industrial equipment, chemicals, which are not typical in the venture
Venture.
capital. The better sectors, obviously, tech, services, and stuff like that, healthcare even, which are typically funded by different venture capital funds. So the high risk areas could be, B2B, basically private equity, B2C, or something like that.
But this is also brings up another interesting point that I want to double click on. So, there definitely are some businesses that, deep tech, et cetera, that could be affected by the tariffs. And there's certainly the beginnings of a trade war happening in the world. So obviously, if you have a thesis that's deep tech and importing stuff from all different parts of the world in your portfolio companies, that's going to be somewhat problematic right now because investors might be more skittish than usual. But there's a silver lining, right? Which is that in general, it's venture capital is a risky asset class. And as you were just saying right now, it's riskier than private equity, it's riskier than debt, it's riskier than,
But, but,
T-bills. But
but
actually,
I
for the
would,
first time in history, it's safe to say that everything else is pretty risky, and venture capital comparatively is not as risky as it once was, right? I mean, like
yeah,
if you look at private equity is a great
yeah,
example. Private
yeah,
equity is
private equity, much worse right
yeah,
now.
but traditionally, private equity is like
Yeah,
very safe. You're going to get, I mean, relatively, you're going to get, it's riskier than, let's say, bonds, but definitely safer than venture capital. And right now, it's private equity is probably riskier than venture capital, or at least
in
the same.
particular, in particular in those sectors that are not service sectors. The
Exactly. So
good,
I
the yeah.
So, I mean, we also have to look as a VC. Sorry to lecture the audience here, but I'm with you guys. We're raising as well. We have to look at the bright spots alongside the negative, and then turn the negatives into positives. I mean, that's what we have to do. And the reality is, these downturn moments or moments of uncertainty have been the single best times to invest in history, right? There's tons of evidence to that. So that's a feather in our cap right now as venture capitalists and working in that field. But the other is the equalization of risk, right? You can argue at this point that venture capital is less risky because everything else is more risky. So, then on a risk adjusted basis, it makes for a great thing. What might be some other positives to think about in this market, Marco?
Yeah, there are always different sides of being positive or negative. I would say that the hierarchy is that most affected are obviously exit markets, IPOs. That we know already because the VIX is up and the numbers are down, so it's very difficult to get exits on the listed market. I would say that moderately affected would be maybe fundraising and LP allocation, and the least affected is deal activity.
Yeah. Well, so look, let's talk about that for a moment, the LP allocation, right? So LP allocation schedules are in chaos right now, right? Because just going back to something we said earlier, if you're a European and you've invested heavily in the stock market as your primary, and then some other things, and most of that stock market's investment is in the US, you have a double down, the dollar falling and the market's falling. So now your big allocation into the markets is smaller. VCs don't mark to market their portfolio as quickly, so their portfolios, let's say, are staying the same roughly,
Yeah,
and now as a percentage, they've ballooned.
yeah, yeah.
Um, and that's just difficult, right? So, what's your let's just double click on that for a second. What's your experience on, you know, when do
You,
these large LPs refactor their allocation, or do they wait to the end of the year, or
you're
what's
talking about denominates
yeah,
effect,
yeah,
and that's a big problem because you normally make these plans for your investments for a year or so, and the allocations were decided sometime in maybe November, early
yeah,
December, and you just don't play with those numbers easily. And what I've seen in the past is that the denominator effect is the most important effect when it comes to allocations. You just tend to avoid to go over the allocation you have, and that is pretty tough. And people
so
say,
you're really talking about next year then before.
basically, it could happen because I've seen that happening quite a few times in the past when I was running the shop. And there's so little you can do about it because this is not the only asset class in an institutional portfolio. This is just one of the asset classes. And there would be a big fight if everybody would, every time something happens, they would say, and I need more allocation. And this is just temporary. It cannot be done. And I got so many, I remember in particular GFC, which was a big one and it happened fast. And I got so many GPs calling me that they asked me basically, are you guys idiots? Because you should know that now you should be able to allocate. Why don't you do it? And it just couldn't. There was no
So
way. And by the way, a friend of mine told me what happened after the dot-com crisis. There is this one extremely big manager nowadays managing more than 1 trillion, and they were raising capital for their fund, which was relatively small compared to these these amounts of money they are raising nowadays or having under management. It could have been something like $1.5 billion fund. And then what happened was 9/11. And all these commitments they had for the fund were cancelled. All of these commitments. My friend was the only one who didn't do it. He
Wow.
was the only one who didn't do it. And I got to say that they're pretty good friends nowadays. And the guy,
Well,
I'm not
yeah.
saying the name, but the guy is a billionaire running $1 trillion business. But that's what happened on 9/11. But then again, the LPs came back, you know. But that was the ultimate uncertainty you can face because nobody could, you know, see that coming. And it came. That was like a black swan effect.
That
But
was a total black swan effect.
yeah,
This is
yeah,
less of a black swan effect.
less. Yeah, much
So
less.
the president of the United States, who's the cause of a lot of the uncertainty right now, is pretty much doing things that he said he was going to do.
Absolutely.
Uh,
Yeah,
maybe like a bull in the china shop, but he is doing what he said he's going to do. So at the end of the day, if you're like, my God, what's going on? It's like, well, he just he said he was going to do these things, and he is in fact doing them. So like, how shocking is this? It's not like, all of a sudden there's a terrorist attack or something like that.
yeah,
So like maybe we could talk more practically because I think there's a valuable insight that you just gave, which is that larger LPs, which tend to be the backbone of larger early emerging manager funds, so fund one, fund two, fund three, if you want to get to bigger sizes like 30, 50 million, you need to get larger LPs that are putting 5 and 10 million checks in, right? And a lot of those larger LPs have this denominator problem, which is that when certain things shrink, like this equities market, the debt market, the treasuries market, the every market, and let's say venture capital doesn't shrink because it doesn't mark to market as quickly and marking to market's not so precise, all of a sudden venture capital grows, ergo the denominator problem, as a percentage, and it breaks the allocation schedule. And as you just brought up, that's kind of done on a yearly basis.
yeah,
So these LPs are not available until probably next year
yeah,
right now. Most of them are sitting on the sidelines.
yeah,
So who are the LPs that are available? What we're seeing are what we call emerging LPs. Now, these are limited partners that are new to the venture capital asset class. They could be family offices that have not invested in venture before. They could be high net worth individuals, people that have come into money recently because they've had an exit. So executives that like all the members of Wix are going to be very rich right now with money to
yeah,
deploy. Um, and those emerging limited partners seem to be very interested in the asset class, largest LP Institute cohort. Would you agree with that assessment?
yeah, absolutely. And the thing is that the big boys are in trouble right now because of the denominator effects. I would say that some of the endowments are struggling with liquidity that we know. And the best LPs for emerging managers in venture capital would be, as you already mentioned, some family offices, obviously fund of funds if they have capital to deploy, and high net worth individuals, the emerging LPs. The good thing about many of those is that they are still under allocated um, to the asset class. By the way, I did something in 2007 or 8, GFC, the markets came down, and I knew that I had the problem with that denominator effect. I went to the chief investment officer and I made a 25% markdown on our entire private portfolio. So I fixed that. And what I
Well,
did
that's
after that, I bought like crazy secondaries.
Yeah, you had mentioned earlier that you think secondaries are a bright spot. Maybe you want to add some
They,
color.
yeah, I would say that secondaries typically are a bright spot if the bid-ask spread is getting narrow. What I saw during the past couple of maybe 6, 7 months was that the bid prices, bidding was getting higher, and the it started to look pretty good. Um, and the bid-ask spread getting smaller. What I've seen and heard right now is that there are some bidders, but the ask prices haven't come down yet. But I would say that definitely if there are sellers, forced sellers, or somebody who loses their faith on the asset class, whether it's private equity or venture capital, these times can be great to be a buyer. But obviously, you need to have some liquidity and you need to have some guts.
Guts and liquidity for the LPs. So look, let's they're good questions coming in. So do me a favor, get your questions in the Q&A. There's some thumbs to upvote. Uh, in my experience in these times, the managers really need to be confident in what they're selling. They need to seem and be assured in themselves, in their offering, in the value that they're going to produce. And that tends to be the best. What I it's so for me, a lot of success right now for a manager is a mindset problem. If they are reading the news, believing all the negativity that they're seeing, and it affects their mindset, then they're going to struggle to fundraise. They're going to struggle to get LPs to believe in their vision, etc. If the managers conversely can say, hey, I am the prize here. Now is a great time to be investing. We have a fund that's going to return really well. You should get on board. That type of positive mindset is really the difference between success and failure. I'd love to hear if you have any thoughts on that or any further comments
Yeah,
you'd like to share. Get into some
this
questions.
is extremely simple. It is that the good managers are able to get commitments regardless of the times. The bad managers are not able to get any commitments regardless of the times. I mean, that
But
is the survival of the fittest. The good ones can always make it happen. And it's all about to have a good thesis, good strategy, good team, a good understanding, not being too negative. And one thing I would say that during these type of times, it probably is not a good idea to be too aggressive. And the reason is that if these people already have a portfolio, and if they have a portfolio of different assets, they are bleeding. And if you get in there, in a wrong way of saying things, being too aggressive, they might not like it because
okay,
they are not in a happy place, in a way. So you gotta have a good tactics. You gotta be positively friendly with them and understand and try to close the deals. That's how it goes.
that's a really good point, and I want to bring up one thing to double click on it. Like you should be looking at the market. Today is down 2% in the Nasdaq. Well, actually 1.6%. Um, maybe not the best time to hound someone for money, right? Because they may be in a stock that's down further, right? Like, I'm sure they're 1.5 or 1.6% is the average. Some stocks are going to be down more, some stocks are going to be down less. So you want to be cognizant of what's happening in the market. Maybe your LP is in physical goods and the tariffs get announced, right? So you be cognizant of what's happening in the market and make sure you time your ask with an LP or time a reminder with an LP, whether it's a capital call reminder, an ask, and time those things around the market circumstances. That's just good management, right? You're a money manager. Don't ask for money when everyone's looking at red on their entire portfolio, if you can avoid it, right?
The,
You
the,
know,
the, the other thing which is quite important, and obviously it's easier with institutional and professional investors who are familiar with the asset class, I probably wouldn't talk too much about these markets at all unless they ask me about it. Because, you're asking money for the next 15 years or 10 to 15 years. Nobody knows how the world is going to be there. Uh, but obviously, you have to be very, um, you have to understand the human psychology as well. And you should be, some of these things that happened to us maybe during the GFC was that um, there were first time managers who haven't been investing yet at all. And they didn't understand that they talked with people who have been investing in 25 years and they had a big legacy portfolio. And you have to understand what is their situation when you talk with them. And I would say that the best situation is that if you're able to talk with people who are relatively new to the asset class, who are not overcommitting capital and maybe has some allocation left there. But if somebody hasn't got any allocation, is overcommitted, it's going to be a difficult sell. So basically ask these questions, understand where they are. If you find out that they actually are hesitating, they don't have a big portfolio, they don't have a legacy portfolio, you can have a different approach. If they have the legacy portfolio, if they're hesitating, you need to talk about the portfolio construction they are having there and maybe, saying that if you're able to do it, it's time to get some average down, so to speak. It's always
right.
adapting to the circumstances. And it means that you should have some understanding about the potential LP situation because they are different. Many times when I met GPs, they didn't know what we were doing. And that was
Yeah, and it's
surprising.
yeah, so actually making it more conversational as a GP with the LP about what the limited partner situation is, right? This is another thing that I find a lot of, to your point, uh, rookie GPs, it's a rookie GP mistake to talk more than you listen, right? And I'm not saying that you should necessarily listen much more than you talk, but at least try and get it at least 50-50,
Yeah, yeah.
right? Where you're talking as much as you're listening, right? Because a lot of if an LP is talking to you in this market circumstance, that's already a great sign,
Yeah,
right?
absolutely. They are interested. And if you don't know anything about them, which can happen sometimes, in particular with private investors, you might know very little about them. Ask
You
some
may know
questions.
them, but you don't know their investment
Yeah,
strategy.
what they've done, what they've done and what the situation is. Try to get to know them a little bit better in that way, if possible, because, otherwise you are just like pitching your stuff without knowing where they are. And what the LPs, think is that many GPs, or most of them, think that they are a unique snowflake. But there are so few of those. So how you make the presentation can make the difference because there are so few extremely unique venture capital funds or fund managers. But you have to be able to make the presentation that you are unique enough.
So I like that. I mean, that's a great piece of advice that, you may think you're more special than you really are, but what and I'll add to that in a kind of constructive way in that, as I was saying before, if an LP is taking a meeting with you in this market environment, that's already a great sign. So in some ways, they've got their toe in the water and they're looking to invest in the asset class because there's a lot of positives in this market. Let's remunerate some of the ones that we covered already. Um, when the markets are down, venture capital tends to do the best, and we're in one of these cycles right now. The risk of venture capital compared to other asset classes is very normalized. So venture capital isn't as risky as it would normally be. So those are at least two. Then we talked about a lot of stuff with the LP mindset. There's a lot of capital sitting on the sidelines right now, looking to reallocate, especially in this emerging LP category. So you have a really big opportunity. And if an LP wants to meet with you, that's a great sign. And so to some extent, they have their toe in the water, so you can almost let them sell themselves, right? They're thinking to invest in the asset class. So if you're selling right now, you're probably going to scare them away, right? Because everyone in times of desperation is selling, like buy my stock, buy this, buy that, right? You let them sell themselves. To let them tell you what their concerns are, what they need, what they want, and let them do at least half of the talking, if not more. And that could be one of the best things for you. Okay, so Jordan's asking, and this is a great question for you, Marco, but I'm happy to take a stab at it as well. Which sectors may benefit from the current trends? For example, software, remote communication tech outperformed while travel may have uh, cratered during the pandemic. So, like, what are the sectors right now that you would say are kind of boom sectors? Like, I mean, obviously, guys, AI is doing very, very well.
Yes,
Um,
AI definitely is going to be all over the place. Um, Sometimes these sector things can be difficult to answer precisely, and this is a question you hear mostly from venture capitalists. They are so sector oriented because people like to be specialists. I would say that it also depends on if you are a VC in the United States or in Europe or in some other place. I would say that my guesstimate is that if we get that uh, tariff trade wars, the U.S. investments in general in venture capital are going to be better protected than investments in some other countries. Because it's basically the United States right now who wants to put these tariffs on these foreign services even and products and stuff like that. And the US market itself is so big. It's not that much dependent on the other markets as the other markets are dependent on the US markets. I would say that uh, because the United States, most of the markets where the venture capitalists are big enough if you have good companies. Healthcare definitely is something that is protected in venture capital. It doesn't matter what kind of trade wars you have, you know. It's here. Then AI, obviously, um, some sectors that might not be protected are like B2C, because basically these tariffs are like taxes, you know, in a way. And if it creates inflation and if the US consumer is getting hit, then that could be, you know, more problematic. But those questions are almost impossible to answer. I mean, if I knew, I wouldn't be sitting here.
ah, well, yeah, and but you can make some educated guesses, as you were saying. So
Yeah, it's
assume
guesses in a
that
way.
trade wars are going to happen, which is a safe assumption given the tariffs that are going on, then obviously America could be a safer place on the whole to invest, as you just brought up. Tariffs might affect things like deep tech and robotics negatively, at least in the short term. So while it's a popular segment, it might be difficult to get the economics to scale those businesses because if you have to take parts from all these different regions of the world to make a robot and suddenly there's 20% price increase, that's what the
Yeah.
margin on the entire robot might be. So all of a
Mhm.
sudden the whole thing becomes much more expensive and that would slow adoption, right? So
Yeah. I would also say that when I spoke that Europeans are not investing in the United States right now, I'm totally sure that it's even more so that the US investors and LPs are not going to invest in Europe right now. That's is my
Yeah.
best.
So that's
Story.
that okay, so let's double click on that statement for a moment. Right. So in the midst of an uncertain global trade war,
Yeah.
cross-border investing almost by definition is going to slow down because people are like, wait a minute, like what's going to happen in this other country? I don't know. So I'm just going to hold off on investing until I have some greater clarity. Right now, most capital for venture capital firms and funds worldwide comes from the United States. So if you're in Africa, you can get African LPs. That does happen, but that's a smaller number than the available dollars in the US. So a lot of European funds, a lot of foreign funds rely on US investors because they're the limited partners that understand the asset class the most. So there could be a silver lining here, Marco, where because of these trade wars and people kind of recentering home, U.S. investors, limited partners will concentrate in the U.S., but this might open up opportunities for LPs in Europe and Africa and their various
Yeah.
markets to invest locally. One
I
can
think, yeah,
hasn't
I
happened.
think, yeah, I think it's exactly what should happen. And
Hope,
the old good rule of thumb, which people don't believe when I'm telling them, as a first-time manager, smaller manager, you should be able to raise your first relatively small fund within 100-mile radius from your hometown. You should be
um,
able to do that.
KT is asking, can you point us to some data that shows, yes, KT, I have that shows that when risk go and market uncertainty happens, returns go up. I actually have that as a slide. I'm going to paste it into the chat here for everyone to see. This is a bit of an old slide, but the reason when I say old, the data in it seems old, but you want to wait for the 10-year mark on a fund to know how it actually returns. So if you look at fund data from 2021 and 2022, it's like 3 years ago. It's too soon. Venture returns don't really start kicking in until about year five, and you don't really know how venture performs until year 10. So you want to look at data for a bit older. So you can see dips in the market happening marked in red in the slide I just posted in the chat, followed by a massive uptick in venture returns. It's just, this is well known. All right. Pash is asking guts, courage, and liquidity. You brought that up a little earlier, Marco. How does risk assessment factor in with those, with guts and liquidity, right? So you can have guts and you can have some money, but I mean, and I have an answer to this, but I'd love to hear what your answer is.
Yeah. First of all, the two biggest problems in venture capital investments, in my opinion, is that you have too much money or you don't have money at all.
Hmm.
Because if you don't have money at all, there's nothing you can do about it. If you have too much money, you just are getting the average returns by being able to only invest in big funds, which are nowadays almost like private equity.
Yeah.
It's being like that. Um, but I would say that uh, the funny thing is that when times are like this, even those who do have liquidity are a little bit afraid of making commitments. And at the same time, when things are going too well, everybody's doing it because they have that good old fear of missing out mentality. I think you know, the business itself is being able to do things differently if you have the liquidity. And it really means that I've done it quite a few times in the past. And the funny thing is that when it's difficult to find commitments and buyers, it's normally the sign that it's good time to invest in.
Ah, yeah, so when it's hard to raise
Yeah,
capital, it's
yeah.
a good time to be an investor.
It's an LP friendly time.
Right. So it's an LP friendly time, but that means it's a great time to invest, which is
Absolutely.
a great
Because
oxymoron.
because people, everybody's like sitting in their foxholes. And this is something I was taught in the military. You have, actually two alternatives. You have to charge or you have to retreat, but you can't stay sitting in your foxhole sucking up your thumb. And this is, something, and I would say that you have to be able to make these calls if you have the resources and liquidity. It's a tough world because we tend to like to do things exactly the same way as our neighbors are doing.
Yeah, and so listen, that's a really important point that you have to bring up. It's that like, in fact, your question about risk is good, but the reality is because of the market uncertainty, venture capital's relative risk has decreased. That makes it an attractive investment in this time period. And the second selling point is that venture capital returns take a number of years to um, materialize. And so if it's a downturn right now and you invest, you're investing when things are low. Over the next few years, it will get better. And so you'll harvest returns as the market goes goes up. And these cycles down up. So you invest at the down and you harvest at the up. So you want to be investing now, right? That's the great oxymoron that you were talking about. Osama's asking any insights regarding corporate LPs and CVCs responses to the current situation. In my experience, they're a little bit more stable because they have had budgets allocated, but it really is very dependent on the parent company business. So, like, let's say by now the CVC has its budget allocated for the year. But in large corporations that might be hit by tariffs or something like that, they could totally pull the first budget to go is their CVC budget. So if the business isn't that affected, they're relatively stable. But if the business is affected, their CVC budget's gone. That's what I've seen. But Marco, I don't know if you want
Yeah,
to add it.
absolutely. And I think this situation right now is different from the normal situation. Due to the past crisis, they were definitely more stable. A good friend of mine is running probably the most successful corporate venture capital business of all time. And they've made a lot of money during the past 20 years. Uh, and if they find something that they find interesting, these times could be excellent to get into these businesses, uh, given they have the liquidity. But for many corporate VCs, the situation could be different because of the parent company and uncertainty. And basically, what happens there is that the CEO tells them not to do much, and then they won't do anything because they don't get paid for IRR, hurdle rate, normally anything like
Yeah, they
that.
don't get any upside. They get a salary.
No, yeah,
They're
they might
like,
get a good salary, but they're in different business.
yeah. So the partners at CVCs are employees. And if the CEO says don't invest or the business doesn't have the capital, then they just get their salary and they sit on their hands, right? There's a question here from I don't want to say your name wrong, Narayan. Hopefully I got it right. Given the current confluence of risk, do you think emerging managers will face more challenges raising from LPs? Absolutely. This is going to be a very difficult fundraising environment, not for the weak of heart. But if you're confident, if you're target correctly, you will be able to raise. I don't know if you agree, Marco,
I
but
do agree, and it also sometimes it depends, but in general terms, I would say that this is the situation. It shouldn't be easier right now, and it won't be easier because of this. On the other hand, I would say that uh, some of the established managers or the, you know, in between managers might also struggle.
well,
I would say
that's actually a very good point you just brought up. I want to double click on also. So this is so you know in 2021, like Andreessen Horowitz raised $7 billion, and like so and so raised 9 billion, like SoftBank raises blank billion, right? And you're like, whoa, and you're going out and trying to raise 10 million or 5 million or whatever, but not billions, and it can be very it's almost like all the oxygen sucked out of the room because these big guys are pulling down enormous funds, and so your tiny fund seems, inconsequential. And right now, that's just not going to happen. They can't do it. So, and they have so much money, they don't need to do it. So they're not raising right now. So if you can go out and raise right now, which I think a lot of emerging managers can because they're going after emerging LPs, they're going after smaller fund sizes. Your relative attention is going to be high because you're one of the few people that can close in this market environment. So, like,
it's
you can get a
definitely,
TechCrunch article,
yeah, it's
right?
it's definitely a good idea to keep the fund size small rather than too big, even for first-time managers. It's a good advice. Um, and I think that if I compare like managers who raised their first funds in 2021, they might have been able to raise like 20 to 40 million. And during these times, like like today, they probably wouldn't have been able to raise more than five or so. But the good thing about it is that if you're raising your first fund, and if you didn't raise too big fund, your first fund in 2021, your chances are that you might be more successful raising your first relatively small fund than somebody who raised quite easily a bigger fund, deployed all the capital, and now wants to raise the fund that is about the same size or bigger. A lot of these people are going to fail. They're just going to fail and disappear. And it really gives a new opportunities for first-time managers and new emerging managers to get
Well, who
into that
think
place.
the right fund size, have the right strategies.
Yeah, yeah,
Um, Gurinder is asking, any thoughts about the U.S. Canada cross-border investing and startups doing business in both sides of the border? I mean, guys, I think for all the questions relating to cross-border activity, I think that's going to be a very challenging situation given the fact that there's an active trade war by the US president right now. It's not clear how serious he is because he put tariffs on everybody, but he put a hold on the really big tariffs for 90 days, presumably to get everyone to negotiate. But if you're doing cross-border stuff, you're doing cross-border stuff at a time of a trade war, and I think investors are going to be concerned. Marco, if you want to add
yeah,
anything.
absolutely. Yeah, the big risk is there. Yeah,
There's a question here from Vivek, and I see you asked multiple questions. So I'll try to ask one question at a time, a little easier. But what are some of the strategies to reach out to LPs, and what is it they expect to see when a VC approaches them? I mean, look, generally speaking, there's something called general solicitation. So you can't just reach out to LPs that you don't know. You must only reach out to people that you know and that you have reason to believe are wealthy. That those are if you apply those two rules, this is universal almost everywhere in the world. There's some exceptions, but that's the two rules. You must know them and know that they are wealthy. Then there are different rules in different countries. Europe is a little stricter. US is by comparison a little looser. Those are maybe the polar opposites. Singapore is probably the most strict. So you can't just reach out to random people. You have to reach out to people you know and believe that they are wealthy. So here's what I would say, just, look for people that believe in you and the market you're going after, forge a relationship with them, and that's your best strategy right now to fundraise, especially if they're and someone who is come into money recently, potentially an emerging limited partner. Those are your best targets. If you sign up for Decile Hub, our platform, there's a waiting list. We have an event tomorrow. Maybe Domenica, can you put the link to the event tomorrow in the chat? We're in Decile Hub, there's an LP archetype advisor tool, and it will provide you with LP archetype ideas. Um, Marco, let's end right now with some closing remarks because we're running up on time, and of course, like usual, people always got their questions in last minute. But I want to get some closing thoughts for everyone. Do you have some closing thoughts you want to share?
I say just the best of luck. You're doing the right thing. Uh, Times are difficult, but then again, conditions are never perfect. So this is
Yeah,
as good a time as any.
you're gonna this is weeding the wheat from the chaff, right? The strong from the people who can't make it. So back to Marco's point, if you're one of the ones who's willing to go out there, put yourself on the line and try and fundraise, you're going to be in a much better position and you're going to stand out. And if an LP's talking to you, you can let them sell themselves because they're already interested in the asset class. They're meeting with you for a reason. So thank you, everyone. Have a great day. Hopefully this was helpful. I certainly learned a lot and uh, go at it. You can do it.
Thank you. Bye.
Bye, guys.